Something was filed inside a government database this week that the financial press picked up, misread, and buried in a paragraph that most people never reached. That filing was not a tweet. It was not a rumor. It was not a crypto influencer's price prediction. It was a mandatory regulatory disclosure from one of the most powerful financial institutions on the planet. And the number inside it is $154 million. Goldman Sachs XRP, $154 million. While the mainstream press called it a footnote, I want to tell you exactly what that document actually means, because what it reveals has nothing to do with Goldman Sachs and everything to do with what happens next. Let me pull back the curtain. Welcome back to Ledger.Wealth.Network. This channel exists for one reason: to translate the language that institutions speak. Filings, patents, architecture decisions, regulatory positioning, into plain English, so that informed, patient investors can see the structure of what is coming before the crowd does. Before I continue, this is not financial advice. Do your own research. Consult a qualified professional. Now, let's get to work. Let me start with the hard truth, because it is the foundation of everything that follows. The Goldman Sachs filing that everyone is talking about is not news about Goldman Sachs. It is news about a structural reality in institutional finance that most retail investors have never been taught. And that reality has a name: disclosure lag. Here is how it works. When a major institution, a hedge fund, a sovereign wealth fund, a bank, builds a position in an asset, they are not required to tell you in real time. They are required to file disclosures on a quarterly basis, in some cases with longer lags depending on the instrument and jurisdiction, which means that by the time a document reaches the public record, the decision that created that position was made weeks or months earlier. Goldman's $154 million XRP filing is a backward-looking window. It tells you where Goldman was. The position you are reading about in that document was built before the filing date. The compliance team signed off, the risk committee approved it, the investment committee authorized it, and then the clock ran on disclosure timing, and eventually the document landed in a government database. Here is what that means for you. Goldman's public $154 million is the floor of their conviction, not the ceiling. Think about that logically. You do not get $154 million through Goldman Sachs's risk management and investment committee on the basis of hope. Goldman's internal research team stress-tested the regulatory environment. They modeled the supply dynamics. They ran the institutional adoption curves. They consulted with their regulatory relationships in Washington. And the output of all of that institutional-grade analysis is a position. We cannot read their internal models, but we can read their output. And the output is $154 million in disclosed XRP exposure from a firm whose compliance department has standards that most institutions would not clear on their best day. That analysis exists. It is real. And what it tells every other institution watching, every pension fund, every sovereign wealth fund, every compliance department that has been looking for a green light, is that Goldman's internal conclusion meets the bar. The bar has been met. The signal has been sent. Now let me show you the math that the crowd consistently ignores, because when you run the numbers, the Goldman filing stops being a data point and starts being a pressure gauge. Here is the core mathematical reality of XRP as a settlement asset. The global cross-border payment market processes approximately $150 trillion annually. The foreign exchange market alone clears $7.5 trillion every single day. The Nostro and Vostro accounts that banks maintain around the world to pre-fund international transactions have an estimated $27 trillion in capital locked inside them at any given moment. Capital that is sitting idle, generating no return, existing purely because the current correspondent banking system requires it. XRP's on-demand liquidity model eliminates the need for that pre-funded capital. That is not an opinion. That is the technical design of the system. When a bank uses XRP as a bridge currency, the transaction sources liquidity in real time. The Nostro capital requirement drops. The float cost disappears. The settlement time compresses from 3 to 5 business days to 3 to 5 seconds. Now here's the math that matters. XRP has a fixed total supply of 100 billion tokens. Circulating supply sits at approximately 55 to 57 billion. On-chain data from Glassnode and CryptoQuant shows exchange reserves declining consistently. The kind of supply drain that happens when long-term holders remove tokens from liquid markets and the bid continues absorbing what remains. If XRP captures a single-digit percentage of the Nostro and Vostro capital that is currently trapped in legacy correspondent banking infrastructure, you are talking about trillions of dollars seeking access through a token pool measured in the tens of billions. Price is the variable that balances that equation. This isn't a prediction, it is a requirement. Let me give you a number to anchor that. At current prices near $2, a $1,000 position holds approximately 500 XRP. At the near-term institutional consensus range of $8, which represents the upper bound of what multiple institutional analysts have independently modeled for the bank adoption phase, that position is worth $4,000. At Standard Chartered's publicly stated 2027 target of $28, that same position becomes $14,000. At single-digit market capture of the global cross-border payment corridor, the math extends further. The fixed supply does not grow. The demand that is building behind institutional gates does. If you have a problem with these numbers, you don't have a problem with me. You have a problem with the laws of supply and institutional demand. Goldman Sachs is not operating alone, and this is the part that the mainstream coverage almost always fails to connect. Because the pattern is only visible when you look across institutions simultaneously. JP Morgan has been building the Onyx platform since 2020. Onyx currently settles approximately $1 billion per day in repo transactions for JP Morgan's institutional clients. That is real volume inside the world's largest bank on a live blockchain settlement infrastructure. The architectural decision to build Onyx with EVM compatibility, at the same time the XRP ledger completed its own EVM interoperability upgrade, is not a coincidence. Institutional technology decisions at JP Morgan are made by teams that plan interoperability requirements years before implementation. The bridge was designed to connect. Both sides knew it. Bank of America's shadow position is visible in a different kind of public record, their patent portfolio. They have filed patents covering XRP-based international payment processing, patents covering blockchain foreign exchange settlement referencing Ripple's technical architecture, patents covering distributed ledger compliance monitoring built for Ripple's network. Each patent filing required legal resources, technical resources, and strategic sign-off from senior leadership. Bank of America processes $680 billion in annual payment transactions. A 60% reduction in cross-border payment friction at that volume is not a marginal efficiency gain. It is billions in annual cost savings. They filed the patents because they intend to use the technology. Morgan Stanley has added XRP exposure to client portfolios through their wealth management division. That is not a rogue financial advisor making an unsanctioned call. That is an institutional product decision, compliance reviewed, risk management approved, product team authorized. It means XRP now meets Morgan Stanley's standards for client portfolio inclusion across one of the largest wealth management networks in the United States. While retail investors are staring at short-term price charts and posting frustration in comment sections, Goldman's compliance department is signing disclosures, JP Morgan's engineers are building EVM bridges, Bank of America's legal team is protecting a patent portfolio, and Morgan Stanley's wealth advisors are including XRP in portfolios for clients whose minimum account balances start at 7 figures. Smart money does not FOMO. Smart money positions. The positioning is documented, the filings are public, the patents are searchable, the infrastructure is live. Now let me lay out the specific sequence that converts institutional positioning into public price discovery, because timing matters as much as the thesis. Goldman's filing is the starting gun. Every institution that has been sitting at 80% conviction now has Goldman's public disclosure as the data point their compliance committees requested before moving to 100. The cascade effect in institutional markets is real and documented. When Goldman crosses the disclosure threshold, the institutions watching that threshold move. The Digital Asset Clarity Act, currently in committee markup, is the legislative event that converts regulatory interpretation into permanent federal law. When commodity classification is codified, not interpreted, codified, The last remaining legal objection at the most conservative institutional compliance departments disappears. The banks that have been building shadow positions while waiting for legislative certainty get their certainty. BlackRock's XRP ETF is the legitimization event that changes the conversation from "is this appropriate?" to "what is our sizing?" The Grayscale XRP trust conversion to a spot ETF, combined with current ETF inflow trajectories, puts the $3 billion AUM threshold that historically triggers BlackRock's internal evaluation process within reach. When BlackRock files, the shadow becomes a headline. The window between Goldman's filing and BlackRock's entry is not weeks. It is not years. It is the specific quarter we are operating in right now. The catalysts are sequenced. The infrastructure is live. The shadow positions are documented. The question is whether you recognize the sequence before or after it completes. Here is the brutal question you need to sit with. If Goldman Sachs, with every analytical resource available to a major financial institution, concluded that a $154 million disclosed position in XRP represents a sound risk-adjusted allocation, what does that imply about the expected return range they modeled internally? Goldman does not deploy $154 million into a 10% upside trade. Goldman's risk committee does not approve allocation to an asset without documented internal price targets, internal adoption timelines, and internal stress tests that justify the exposure. That analysis exists. We cannot read it, but we can see its output. The structural floor, defended by over $400 million in on-chain cost basis accumulation, puts downside from current levels at approximately 10%. The institutional targets, from near-term technical levels to Standard Chartered's 2027 analysis to the macro framework output for bank deployment scenarios, represent 200% to over 1,000% on the upside. Goldman did not take a 10-to-1 downside trade. They took an asymmetric setup, the same setup that is sitting in public filings, patent records, and architectural decisions that anyone with the patience to read them can access. The window is not closing tomorrow, but the window that exists when institutional positioning is documented and public price has not yet reflected it. That window is a function of time, and the clock started when Goldman filed. Goldman Sachs filed. JP Morgan built the infrastructure. Bank of America protected the patents. Morgan Stanley opened the portfolios. BlackRock is at the threshold. And the U.S. government has shifted from adversary to architect. 7 institutions, 7 independent decisions, 1 direction. The informed investor does not wait for the crowd to validate the thesis. The informed investor reads the filings, follows the patents, watches the architecture, and understands that by the time the mainstream press has explained something correctly, the window is already smaller than it was. Stay patient, stay positioned. The math does not require your belief to function. If you want to go deeper on the patent filings, the ETF flow data, and the on-chain supply mechanics that support this thesis, that content is on this channel. Subscribe so you don't miss the next breakdown. Comment shadow below if you made it to the end. I want to see who is actually paying attention. Knowledge is the only hedge. Stay sharp.